Hello and welcome to the Inside is Capital podcast. I'm Pierre Daly, Managing Editor at advisoranalyst.com. As the Canadian wealth management industry evolves, there is growing pressure in the ranks to continually upgrade knowledge and services among Canada's leading and growing, established and more newly minted advisors, respectively. The landscape is becoming more and more competitive in terms of the proliferation of products, solutions, level of advice and services, as well as technologies used at all levels, the institutional level, the retail level, and also the direct-to-consumer level that are happening. The largest demographic cohort of investors, as measured by assets invested, is entering or already well into their retirement or decumulation phase. To add to the mix, markets are facing and experiencing this year a complex regime change as rising inflation and interest rates have ravaged both bonds and stocks at the same time. The demand for portfolio construction and guidance in this climate has never been higher in the history of the business. And that too means that the value of advice has never been higher as well than it is now, assuming advisors rise to the challenge. Here to share her insight on this evolution and discuss the trends shaping the wealth management business is Erika Toth, Director of Institutional and Advisory for Eastern Canada at BMO ETFs. Erika brings to the table experience in investment analysis, portfolio construction and trading of equities, fixed income, foreign exchange, options, ETFs, and mutual funds. She's known for her attention to detail and consultative approach in providing support and education to advisors and portfolio managers. Erika is a CFA charter holder and has obtained several licenses with the Canadian Securities Institute in derivatives and options trading. She holds a Bachelor of Commerce, double major in finance and marketing, from John Molson School of Business at Concordia University in Montreal.
This is the Inside is Capital podcast.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Erika, welcome. It's terrific to have you. Looking forward to our conversation.
Thank you so much for having me, Pierre. I appreciate the chance to be here and chat with you.
Awesome. Erika, for those of us who don't know you, please tell us about the arc of your career, what you do at BMO ETFs, and what's your heart at work on these days, and in the context of the markets we're in.
Yeah, absolutely. So I've been with BMO for 12 years now. I started within the discount brokerage arm, so that allowed me, to get all my trading licenses and, do my CFA charter at the same time. So really to get a better understanding of markets. And then I moved over to BMO Global Asset Management. It was 9 years ago in August, actually, of this year, where I was helping advisors and portfolio managers understand and integrate ETFs for their clients. So at the time when I joined BMO GAM's ETF division 9 years ago, there were 6 ETF providers in Canada. So the landscape's really changed a lot over the last 9 years. It's become one of the best selling investment vehicles. We've had significant growth, about 22% per year in terms of the annual compounded growth rate. To now we're at the point where ETFs are approximately $20 billion dollars in terms of the Canadian ETF market. There's now 42 providers compared to the 6 that we were when I started with the team here. And there's about 1,271 listed products at the end of last month in Canada. So there's a lot more product out there for advisors and portfolio managers to wrap their heads around, a lot more due diligence required. And so that's where myself and my colleagues come in. So to help advisors and portfolio managers with that homework and understanding the ins and outs of ETFs and how to analyze them and make sure that, they're buying the best possible solution for their clients at the end of the day. And my role, in that 9 years has evolved quite a bit as well. So now I kind of wear 2 hats. I take care of not only the advisors and the portfolio manager market for Eastern Canada, but I also wear an institutional coverage hat as well. So I'm also working with asset managers, with ICPM investment counsel firms, and also with pension funds. So it's been exciting. Experiencing all that growth and watching the industry change so much, but also being able to learn different parts of of the market and how different segments of the marketplace use ETFs. It's been really fascinating. And, over that time, I think ETFs have become increasingly popular because of some of the pressures and some of the changes in the industry. I mean, I think as an industry, it's become a lot more fee sensitive, and ETFs definitely, one of their key benefits has been their lower fees, but they also bring, tremendous amount of transparency. They're highly liquid. They allow portfolio managers to rebalance very easily during the trading day. You can pinpoint a specific allocation. So they're really excellent portfolio building blocks. And I think those are some of the key reasons why they've become so popular in portfolios.
Yeah, I guess, I would say that with the proliferation of the ETF business in Canada and the number of solutions and products that are now available in the market, it hasn't just benefited retail investors, it's benefited advisors, obviously, in their business and accessibility to solutions that weren't available, in many cases, even just 5 years ago. But it's also enabled the investment counselor portfolio managers to also change the nature of their portfolio management as well. So we talk about democratization of investing, but the ETF has actually democratized investing at all levels, not just at the end investor level, but at the retail portfolio management advisory level, at the ICPM level. We've also had the introduction of alternatives some 3 years ago, which has also changed the accessibility of strategies. Very, in some cases, plain vanilla alternatives, but also in other cases, more complex, hedge fund type alternatives are available in hedge fund in ETF formats. But along with those products, there's been a significant learning curve. And can you talk about, since you're talking to both the portfolio manager at the, and advisors at the brokerage level and the investment counselor portfolio managers, what are you seeing as the key competitive differences between the two types of portfolio manager that are out there?
So just to make sure I'm answering the question correctly, you want to know the competitive difference between an investment counselor family office versus a traditional investment advisory like a bank-owned brokerage?
Well, I'm guessing, because we speak mainly to advisors in our channel, since advisors and portfolio managers that are at the brokerage firms are in fact competing with investment counselor portfolio managers, there are some key differences, but in essence, portfolio manager investment advisors now have really a great opportunity to compete in the same playing field as the investment counselor portfolio managers. But can you speak to that? Is that are you seeing that? Is that something that's happening?
Yeah, absolutely. That's definitely a trend that we've noticed over the last several years in terms of the bank-owned brokerages, and there's been a tendency for more advisors to get their portfolio manager designations either by going the CIM route or the CFA route. And typically within their firms, there are certain guidelines that they would have to follow in terms of constructing portfolios. But at the end of the day, the bottom line is that it gives them a wider toolkit, right? And they're able to construct portfolios and make changes to portfolios without having to call their clients every single time. And they could run a portfolio like a fund manager would run their fund, right? So it's given them more flexibility. It's given them more access to different products. And at the same time, it's put more onus on them in terms of due diligence, because an advisor that's licensed as a portfolio manager has to prove that anything that they're putting in the portfolio, that they've done extensive research on it, number one, but also that it's the best product to meet their clients' objectives. And there's more homework, there's more legwork that goes into it, but at the same time, it gives them access to a wider toolkit. And they have more latitude in terms of making decisions. But it's at the same time, like you said, it's kind of leveled the playing field between advisors and independent investment counselors, because they're no longer tied to, let's say, internal product, like maybe some advisors would be. So that's definitely the
Yeah,
trend
so
that we've noticed. And it also helps make businesses more scalable as well. When an advisor becomes PM licensed, they can then onboard more households. It becomes a lot more scalable to run the portfolios rather than sort of taking a piecemeal approach and every client would have a different portfolio. And that's very, very challenging to scale. And I know it's a pain point for a lot of
right.
advisors. So I think that that's also part of the reason why we've seen a trend towards portfolio managers, licensed portfolio managers in the advisory space.
Right. So in essence, I take it that the evolution of ETFs, of the ETF marketplace, has really enabled advisors to be, so the advantage goes to advisors in essence, right? I mean, ICPMs have been doing what they've been doing all along. And we'll get to the key differences, obviously, between the two and the different expectations, perhaps, that clients can hope for from either. But in essence, the advantage has gone to advisors, right? The toolbox now that's available to advisors has far more breadth and depth than used to be. And so now, as you said, for advisors, the playing field has leveled.
Yes, absolutely. But the other thing too is even for investment counselors, like they might have not been using ETFs to the extent that they are now when you compare 10 years ago.
Right.
So like you said, it's really a tool that's democratized investing, like in many areas of the industry, right? Not just on the retail advisory side, but also for smaller pension funds, for asset managers, for investment counselors, and they each use the strategies a little bit differently and I would say gravitate towards different types of ETFs. But I would say definitely like the ability to become a licensed portfolio manager, that's changed the game for investment advisors. Right. And at the same time, like there's more strategies available. Yes, there's more legwork to be done. But there's a lot more tools available as well. And I wanted to talk a little bit about some of the tools and some of the support that we've put together to help them do that job better, because their job has become harder, I would say, in the last decade, because clients have become more fee sensitive, with social media as well. Like the news is available at your fingertips 24/7, probably a bit too much. Right. So there's really some great tools to help advisors navigate that, to help them do their due diligence and make that easier for them. So I did want to maybe talk a little bit about those tools later on if we have some time.
Yeah, I mean, that's a big part of your role is you're actually consulting with advisors on how they're running their businesses and how they're running their model portfolios and how to ameliorate their whole process. What are some of the things that you've what are some of the biggest challenges that you've been helping advisors overcome?
So I think helping them reduce their fees has been really important in terms of like product MERs. So, part of what I do is clients will sometimes share with me their model portfolios, and we'll help them look for opportunities where they could either lower their fees, improve their performance, reduce risk, or improve tax efficiency. And I always tell advisors that I won't tell you to make a change in the portfolio unless there's really a reason for it. Like I won't tell you to change 4 quarters to $1 just so that you have more BMO Z tickers in the portfolio. It's really if there's an opportunity to help their end client or to help them at the end of the day make their life a little bit easier, or result in a better investment outcome for the client. So I spend a lot of my time doing portfolio reviews with clients. And I would say this year, especially given how challenging the markets have been, I would say even more so this year, because now there's kind of a silver lining with the markets being down, is that investors are looking for ways to make their portfolios better. They're taking advantage of tax loss selling, right? So that's been sort of a silver lining, is that it's kind of a good time to take stock of your portfolios and look at where you're at and see where you can maybe tweak or improve things a little bit. So the tax loss selling has been a really, really important conversation this year, especially with, bonds and equities, like you mentioned, being down both, to the magnitude that they are this year. I mean, we haven't seen anything like this since 1969. So we're talking a lot about tax loss selling. On the fixed income side, over the last year, it's been a really painful spot to be, with interest rates being increased around the world. So what we're telling clients is, you don't want to get out of the asset class, because while the central banks are hiking rates like crazy now, eventually it's going to trigger a recession. And, looking a year out, it's going to be a very different situation. And there's actually the potential to make money on bond positions.
Right.
And so what we're,
Now that there's actually some yield.
yeah, I mean, these are some numbers
Yeah.
we haven't seen the likes of in a decade, right? So, I mean, to give a few examples, clients are putting money now into money market ETFs, into cash alternative ETFs. It was a record inflow month last year in terms of the ETF business in Canada. In September, I believe it was $1.7 billion that went into cash and cash alternative ETFs. And certainly at BMO over this last month in October, we saw a very strong month in terms of flows, about $1 billion of net new flows. Close to $800 million of that went into bond ETFs, and the remaining 200 went into equities. So
Interesting.
we're starting to see a shift there because of that. So we're definitely having a lot of tax loss selling conversations, and people are looking at the asset class a little bit more because of where yields are at, right? So if you're looking at a 1 to 5 year laddered corporate bond, all investment grade in Canada, the yield to maturity on that's about 5% now. If you're looking at, a money market ETF, you're getting close to 4% on that. So these are numbers we haven't seen in many, many years. So we're seeing clients put money there. And then the other part of the tax loss selling conversation is we've been talking a lot about discount bond ETFs, because not only can you take advantage of that tax loss sale, but then the advisor could also go into something that's more tax efficient going forward. So it's sort of a 1-2 punch there. So you're taking advantage and harvesting the loss, but you're putting your client in something that's about 30% more tax efficient going forward. So the client's taxed on the bond coupons, and the bond coupons on discount bond ETFs are significantly lower, but the yield to maturity or the total return is very similar to the traditional bond ETFs. So that's one of the tax loss selling conversations we've been having. Also, other areas in terms of tax loss selling, we've seen clients looking to replace individual stock positions where they might be down. So, to name a couple of examples, like Facebook's been in the news, that the Meta stock has had a very difficult time recently. So we're seeing clients use ETFs to replace that, maybe looking to NASDAQ. And with an ETF, what's kind of neat too is that the advisor will have the currency flexibility, or the ability to really pinpoint the currency exposure that they want. So they could choose to go hedged, to go unhedged, or they could even buy the US dollar unit. So that's an added level of flexibility. And then they don't have this single name, liability or exposure that they would have with individual stocks. Another example is the REIT sector in Canada. That's been hit really hard so far this year. So one name that I was talking to a client about yesterday was Granite REIT, and talking about replacing that with our equal weight REITs ETF. And when you look at REITs and you look at REITs in Canada, actually equal weighting has tended to not only increase yields, but increase performance over time versus cap weighted indexes for that particular sector. So these are a few of the examples for tax loss selling and some of the conversations that we've been having. Another example is, we have conversations about where we can take individual bonds or individual preferred shares, which are very cumbersome to trade, and we can exchange them for units of the corresponding ETF. So that's, I think that's been another plus for advisors and PMs, really to help them make their businesses more scalable. We're talking too about, the differences in terms of retail flow and institutional flow. So I wanted to highlight just a couple of things there, a couple of trends that we're seeing, especially on the institutional side now. So fixed income is probably the fastest growing area of uptake with institutions. And when I say institutions, I refer to asset managers, family offices, and also pension funds, so asset owners. And we're seeing them increasingly use fixed income ETFs because of the added operational efficiency. Like, I would say that when you're talking about the advisory market in Canada, I would say the advisory market in Canada actually adopted ETFs quicker than the institutional side of things. But now the institutions are really starting to integrate ETFs, and especially for fixed income. So because individual bonds are, they're harder to trade, they're less liquid, there's less transparency there. That's one of the reasons, or some of the reasons, why we're really seeing institutions now gravitate towards fixed income ETFs and incorporate them in their portfolios. And they're also they're able to pinpoint, specific exposures that they want, whether that be level of credit quality or duration, or even currency, like I mentioned, and they can make changes to the portfolios a lot quicker than they would be able to with individual bond holdings. So we're starting to see a lot
Yeah,
more.
because you actually have price discovery.
Exactly.
Yeah, sorry, I didn't mean to interrupt you. Because you actually have, daily price discovery. So Erika, since you're having these conversations with advisors on tax loss selling, I'm just curious because there tends to be, a bias among investors that doesn't really favor selling, some of their losing stock positions. I'm just curious to know if you're first of all hearing about differences in emotionality between tax loss selling of individual stocks versus ETFs. I think it's probably much easier for an advisor to talk assuming they're not managing money on a discretionary basis, that it's much easier for an advisor to convince a client that tax loss selling, for example, a market cap weighted index in favor of an equal weighted index is much easier to do than getting out of Facebook, which is down, in favor of widening their exposure to the sector at a time when it's also very first opportune. But investors tend to be more attached to their stocks than they are to their ETFs. So I'm just wondering if there's a conversation there that you're having with advisors where they can help their clients take their emotionality out of making those tax loss selling decisions, because they are very opportune. They make lots of logical sense, but they don't necessarily make emotional sense to the client, to the end client.
Yeah, and I think that's a great point that you bring up, Pierre, because anecdotally speaking, absolutely. Like I could tell you, investors tend to be more attached to their individual stock
Right.
holdings and married to them when they're down and saying, okay, well, I want to watch this recover. And so, yes, you're absolutely right that I think for advisors and portfolio managers, it's easier to make a switch from, let's say, one ETF to another. But part of that conversation that we're having is to take advantage of the tax loss and go into the same sector. So you're not giving up a potential rebound, but what you are doing is you're reducing the level of concentration risk in a
Right.
portfolio, and you're reducing that risk by owning a basket of names instead of an individual name. So you're less likely actually to overreact as well when things don't go well, because there's also a tendency for, when individual names go down and are very volatile, some people panic and want to get out
Right.
of them. So I think you're less likely to do that with an ETF, and it also makes it more scalable, and it helps, I think, the advisor convince the clients to stay invested when things do get rocky, which I think is also important. And then the other point I'll make there, just sort of as a another part to the conversation about individual stocks, a lot of people assume, and sometimes incorrectly, that a lot of the growth in the ETF business has come at the expense of mutual funds, which is not necessarily the case. Like, it's not that all money flowing into ETFs has come out of mutual funds. A lot of it's come out of individual stocks and individual positions. For that reason, is because there's actually less volatility, and it's been proven that investors tend to have better outcomes owning a basket than concentrating themselves in individual names. So then, there's a lot of great research to back that up as well. So I wanted to make that point.
Thank you. That's a great point. I think the from a behavioral economic standpoint, behavioral finance standpoint, having a portfolio that doesn't cause you to have emotional reactions too far to the left or the right, too excited or too sad, too unhappy, is a much better long-term course of action, I think, in terms of preventing investors from either over-investing when markets, over-risking when markets are as good as they were most of last year, up to last year, and overselling or over-panicking when markets are down like this year. That's really a key to, as you said, having a better outcome in the long term, and in terms of a better wealth management, wealth result, by having a smoother ride.
And that's absolutely, it's a huge part of the conversation we're having now. A lot of it is going back to behavioral finance.
Yeah.
And, we were chatting a little bit about some of the tools that are available to advisors and portfolio managers now. And I would say, like, every meeting I'm doing now, because of the type of market we're in, like at the beginning of the year and last year, it was like the markets were defying gravity, right? People were,
Right.
everybody was a genius. Everybody was making money. People were just throwing more money in, and people were excited. And this year, it's been very challenging, right? We've seen both stocks and bonds correct. So we have put together a revamped series of tools on the BMO Canadian ETF dashboard. That's our value-added site for advisors and PMs. And there's in particular
that's BMOETFs.ca.
That's right. Yeah,
right?
it's BMO ETFs with an S.ca. And I spent a lot of my time in meetings with advisors and portfolio managers, actually sharing some of these value-added resources that they could use with their end clients. And in particular, we've added this year a section called the Volatility Center. So there's a number of actually non-product, client-friendly pieces, really to help clients stay invested in a tough market, to put things into perspective, to keep them, invested according to their long-term plans. And just to share just a couple of examples, there's one piece that I love. My eyes nearly popped out when I first read this piece, but it shows you over the last 20 years the impact of missing the 5 best days in the market and the impact of missing the 10 best days in the market and so on. But really those numbers were eye-popping. I mean, if you're looking at somebody who started with $100,000 to invest in 2000, the difference, I mean, you're looking at, instead of about 450,000 at the end of last year, you'd be looking at 286,000 if you missed the 5 best days, and you'd be looking at 210,000 if you missed the 10 best days in the market. And, the reaction, even from advisors and PMs, has been equally eye-popping, because there's a reminder too that, the best days in the market, these can happen during a bear market as well. And we can't time it. We don't know when they're going to happen. The reality is nobody has a crystal ball. So on the flip side of that piece that shows you, okay, just how damaging it is to jump out of the market when things get tough. The flip side of that is that, it'll cost you, and it'll cost you big.
Absolutely. Like
so
those are like unrecoverable losses.
Absolutely.
I just wanted to add, I wanted to add that often those best days in the market are often right next to the worst days in the market, right? And so if you're trying to avoid risk, you're taking the risk of there's an enormous opportunity cost of
huge
risk avoidance. And that's a great tool.
I really love that one in particular. There's some great ones too about staying invested for the long term. So showing, over the last 30 years, what some of the major drawdowns in the market have been. And then on the flip side of that page, you'll see, the average annualized return for a balanced portfolio versus equities versus if you went to even a 5-year GIC over that period. And again, it's a staggering difference. There's another great piece on the history of Canadian bull and bear markets going back to 1960, which is quite powerful. And it's a really easy visual too. It's not complicated to understand. It's not 10 pages of text. And it shows you that on average, bull markets in Canada have lasted, 4 times longer than the average bear market. So that's something to keep in mind. But also the average return of a bull market has been, I believe it's about 73% versus the average loss in a bear market, which has been about minus 23% going back to 1960. So not only do bull markets last longer, but the returns tend to be a lot bigger than the respective losses of a bear market. So it shows you, how important it is over the course of several market cycles, and the big difference that can make, really staying invested for the long term. So that's another example of a piece that I love and that I've been sharing with clients on the ETF dashboard. There's also a tool called the Big Picture. So you remember the index charts that were up everywhere? It's kind of like a digital version of an index chart, but what's neat is that you can customize for a particular client's time horizon and their dates, and you can sort of play around with different asset classes, and you can really bring that planning to life with the client and help them understand, this is why we've built the portfolio in a certain way, and this is sort of the long-term outcome that we're planning for. So that's another great tool there. And, you brought up, in a difficult year like this year, where, a lot of advisors are not having fun conversations with their clients. Clients are looking at their statements, and, another bias that investors tend to have is they tend to anchor their portfolio values to the highest level it's ever reached, right? Which is not how things work. You can't look at that in isolation. But another piece is the value of advice that's also on that volatility center, and that helps advisors and PMs articulate the value that they're providing and all the different aspects of the work they're doing, and really focuses on the end result and quantifies the end result for that investor and the difference, overall for investors that use an advisor or PM versus the ones that don't. And again, very eye-popping. I mean, net worth tends to be about, I believe it's almost 3 times higher after a decade and a half of working with an advisor and sticking to a plan versus investors that do not. So I think that's another great piece to highlight for advisors up there.
Yeah. Now, are you talking about the research by Cyrano?
I'm not sure. I think there was some of the research that was done by BMO. Some of it might have been external sources. I would have to double check in terms of that piece, in terms of what the source of the research is. I don't know off the top of my head.
The research is conclusive. I think that portfolio, that investors who are advised and stay advised tend to do multiple times better than those who aren't.
Much better outcomes over time.
But if you can illustrate it, that's even better. Yeah. I think that's a rather big deal. I'm so much emphasis in the industry over historically, not I think it's changing, but historically so much emphasis was placed on, the 60-40 bond split. And I think very little emphasis was placed on the fact that the interest rate risk of a 60-40 portfolio was closer to 90% equity exposure in terms of equivalent risk budget.
Yeah, that's a great point.
And is that something that you're working with advisors to address, is the risk budgeting within their portfolio constructions in terms of, what the, how budgeting risk within a portfolio as opposed to budgeting between assets is actually a much more improved way of looking at portfolio construction over the simple 60-40 bond split
idea?
Say
yes. I mean, that's definitely something we've been having conversations about for the last while. And even within that fixed income bucket, we've been having conversations about the level of volatility in the different areas of the bond market. And so in a sense, when you're looking at volatility and how certain areas of the bond market trade, we're looking at risk budgeting there. So that's important. And I would also say, if you look at we have 2 series of model portfolios. We have our quarterly strategy report that our strategist Alfred Lee puts together. We've been running that model for 10 years now. And I just recorded our quarterly podcast about that model with him yesterday. And that question actually came up about, the 60-40 portfolio. And, instead of doing a traditional 60-40 portfolio, what we've been doing in that model is we've been doing a 50-30-20 split where, 50% is your equities, 30% is your fixed income, and then 20 would be sort of a hybrid or alternative bucket.
Right.
And we've found that has actually helped to not only improve returns, but also reduce the level of volatility in portfolios by including exposure to sort of, alternative asset classes. So a couple of examples that we've been talking a lot about with clients. So Alfred uses preferred shares in his model to help increase yield. But we've also been talking a lot with advisors about the impact of adding infrastructure, let's say, because if you look at the last 10 years, the correlations with broad equity and bond markets have been lower than other asset classes. So we're talking about, I had a conversation with a portfolio manager last week about maybe taking down some of their international equity exposure, for example, and reallocating some of that towards alternatives, towards infrastructure in particular for that conversation. And that part of that was in an effort to reduce the overall risk of the portfolio longer term.
Very interesting times we're in. I want to ask you about the U.S. dollar because of its obvious, behavior this year and how strong it's been. What are you recommending, or, what's your suggestion for investors wondering what to do in light of the fact that the dollar is strong and could have a reversal, some years, over the next few years? as policy changes in the everywhere, not just in the U.S., but as potentially Fed interest rate policy changes and central bank policy changes affect the strength of the dollar one way or another. How do what are a couple of ways to, number one, if you believe that the dollar is going to weaken at some point, how do you position for that? And number two, if you believe that if you want to take a neutral stance on the dollar, what are some ways to consider?
Yeah, so that's actually something that's figured quite prominently in conversations this year as well, just because of the fact that, the US dollar's been on a tear. We've had a ton of volatility in the markets, and in years like this, that's when the US dollar is really, that flight to safety currency, and it certainly has been this year. So we have seen an increased interest in Canadian dollar hedged products. So clients can still access the underlying US market, but they're stripping the currency out of that equation, given how strong it's been this year. In terms of portfolio construction, though, I would say there's a bit of a caveat there, because I always ask my clients, what is the time horizon of this intended investment? And I think that's an important part of the conversation as well, because if it's sort of a portfolio building block, if it's intended sort of as a long-term buy and hold position, in that case, investors are typically better off leaving their US dollar exposure unhedged. And if you look at very, very long-term charts, it typically tends to result in lower standard deviation and slightly higher returns because of stuff like we've seen over this last year, where the US dollar has rallied in a stressed market. So that's why we see those results over the long term. It adds important diversification there. But if you're looking at, the time horizon might not be a multi-decade time horizon, and, maybe you'll reassess the position a year from now, 2 years from now, I think that it could make a lot of sense to use a Canadian dollar hedge product just because of the strength of the US dollar that we've seen. And we're certainly seeing that in terms of the flows. So in terms of, where we've seen money going, broad indexes have always been a staple in terms of portfolio construction. But with an ETF, you have the added control over the currency. And in a lot of cases, for US exposure, we'll offer 3 currency choices. So we'll offer the ability to go hedged to CAD, which strips out the currency out of the equation. You can go unhedged, where you have the return of the underlying stocks plus the return of the US dollar, or you could go in US dollar units, which are becoming increasingly popular, especially for wealthier clients that have US dollars to invest in non-registered accounts. And I always tell advisors, if you want to hold on to some US dollars and physical US dollars, if you have physical US dollars in the portfolio, it's actually often better to look at what's available trading as a .u, we call them here in Canada, rather than looking to what's available trading on New York. And the reason is, for those high net worth clients, you're then not going to have US estate tax exposure, and you're not going to have to file additional T1135 paperwork. So those have become increasingly popular, and there's more and more solutions. BMO has, I believe, 20 of them on the shelf at this point. So those, we've been having a lot of conversations about those too, for clients that, maybe they want to hold on to US dollars because they have, let's say, expenses in US dollars. Maybe they travel there frequently, or they have property there. So that's another reason, clients might want to hold on to some US dollars in their accounts as well. So I think there's different reasons. And, when we have those conversations, it goes down to the portfolio construction level, but it also goes back to the client need. So yes, tactically, I think it makes a ton of sense to hedge out the US dollar right now. So we are seeing, more hedge to CAD flows in terms of our products. But there's also cases where, if you're buying a broad S&P 500 ETF and you're planning on holding that for your client for the next 2 decades, well, then you might want to consider going unhedged. And then for the reasons we just discussed as well, if the client has specific needs and has US dollars to invest in the first place, then why not consider a .u for those particular clients?
Right. So coming back, I want to circle back to the tax loss selling conversation. Does the tax loss selling, does it make sense to use this opportunity that we have at this time to tax loss sell one currency based position in let's say S&P 500 index or TSX, or not TSX, but let's say a US index, to switch from the US dollar version to the hedge to CAD version?
Yeah,
Does
that's
it-
certainly another way that that people could look to take advantage of tax losses because
Right.
prior to this year,
That would be eligible though with
yes, it
CRA.
would.
Yes.
Yeah.
Okay.
So it's considered a deemed disposition, and because the currency exposure is different, it's not considered an identical exposure.
Right.
So yeah, it would be eligible for tax loss selling. But we're in a situation where had to this year, there weren't that many tax loss selling opportunities. Like I spoke to
No.
a lot of people, a lot of portfolio managers that they had gains, right? So that a bad
Right.
market like we have this year, and going back to that history of Canadian bull and bear markets, there's more good years, historically speaking, than there are bad years. So when a bad year comes along, that's sort of a silver lining. And that is another opportunity that people can look to, okay, take stock of where I have losses in my book. And currency is a great way to do that, especially given the strength of the US dollar rally that we've had this year. So yeah, we are having conversations about that and seeing that in terms of the flows as well. So that's
So
a really
it's
astute point
Yeah.
to consider.
As you were talking about it, I was thinking, just maybe, I should ask you about clarifying that because it's not that you necessarily want to get out of all your US dollar exposure, but you could definitely diversify some of your currency exposure by taking advantage of the tax loss selling opportunity
Absolutely.
that exists today. In more than one dimension. I mean, so if you're looking at it like, playing it like a 3-dimensional chessboard, you have all these different layers of thought that you can apply to portfolio construction or reconstruction that are really interesting right now, given the climate we're in.
And tax alpha is one way that advisors can add value for their clients, right? So there's the portfolio management aspect, but there's also the tax management, and then behavioral coaching. Going back to that, like that's probably one of the largest areas. So these are 3 really important things that advisors can be doing for their clients right now.
Yeah.
And to set themselves apart from their competition, I think, as well.
So Erika, thank you very much. That was, I think, those were some very revealing insights. What are some of the, did we cover all of the tools that you wanted to talk about today?
So I did put together, just a series of points and sort of takeaways in terms of what we're seeing in the markets right now. So we spoke about,
Right.
We're seeing investors and portfolio managers allocate to cash as an asset class again. So, last month I would say cash is king, right? We're seeing that because the interest rates are that much more attractive right now. So I would say, a reminder, it might be tempting to go all to cash, but to have, and we talked about the reasons why that's not a good idea.
It's potentially a very dangerous move.
It's potentially very dangerous, but to have, maybe a slightly higher cash allocation and keeping some dry powder and getting paid while you're sitting on that maybe slightly higher allocation to cash, I don't think is necessarily a bad idea, because now you're looking at numbers, like I said, that we haven't seen in probably a decade in terms of returns on cash or cash-like type strategies, and certainly in the ETF space, there's a lot of choice now in terms of ultra short-term bonds or money markets. So cash is king, I would say yes, but there's a caveat there. Make sure you don't go all into cash, and make sure you stay invested. But there's a lot of great tools.
Don't go completely
Don't go
risk
off the
off.
deep end there, because things can turn around, and we can't really predict when that's going to happen. So the second takeaway, bonds are back in a really big way. I mean, we've seen essentially a reset in the bond market. So I think there's going to be some actually really good opportunities there going forward. And I would say, we're seeing that interest not just on the retail side, but also on the institutional side, because you're looking at, much more attractive yields again right now.
We've gone from Tina, there is no alternative, to having tons of alternatives, and bonds are competitive again against other assets, right? And both tactically and, yield wise.
Yeah. And speaking of yields, that's another point that I wanted to bring up, because, enhanced income solutions remain really popular in terms of our product suite, but also in the market overall. And there's several reasons behind that. So we're talking about, when I say enhanced income, I'm talking about things like covered calls, put writing strategies, or premium yield strategies, which use a combination of call selling and put selling. And I would say those are very popular right now for a number of reasons. I mean, some of those key reasons, the aging demographic, right? So there's more people, you mentioned this at the beginning of our chat, there's more people that are relying on the cash flows of their investments. And these not only give that higher cash flow, they give a nice monthly cash flow, but it's also really tax efficient, because the options premiums on the covered call strategies, for example, are taxed as capital gains. So I think that's really compelling. But also, inflation being what it has been this year. It's put more focus onto strategies that generate a higher level of current cash flow. So dividend-oriented strategies have been quite popular, and they've actually performed really well in this market. And you know, the covered call high dividend portfolios that we run, they have that dividend focus, but they're also they have a dual return stream. They have they're yielding the underlying dividends of the stocks, but they're also generating that additional cash flow from selling the options. And in volatile markets like we're living this year, that tends to translate into higher option premiums. So this type of market is very attractive for option writing strategies. You're turning market volatility into a source of returns and into a source of tax efficient cash flow for clients. So those have been really, really popular. And in terms of our lineup at BMO, we're actually the largest manager of covered call ETFs in the world, which is pretty crazy to wrap your head around. And here in Canada, we manage about $10 billion of options-based strategies. We represent about 2/3 of the AUM in the Canadian industry. And strategies that have been really popular, like owning the Canadian banks with a covered call overlay. I mean, stuff like that's yielding about over 7% right now. And that's taxed as Canadian dividends and as capital gains. So really, really powerful tools in terms of generating that tax efficient cash flow. Another one that's been really popular this year has been our ZWU, which is covered call in the utility sector. I mean, it's a defensive sector, which is pretty in demand right now, given what's going on in the markets. So that's yielding about 8.5% right now. So these tools have been really, really popular. A lot of them have, you know, over 10 years of track record. And we're not just seeing investment advisors use these. We're also seeing family offices look to these types of strategies because of their tax efficiency and the higher level of yield as well. So that's another thing that I would highlight. So there's definitely a few reasons behind their popularity. We spoke about the
I've always been, Erika, I've always been surprised at how long the adoption runway for these enhanced income, solutions has been. I mean, buy right strategies have been around for a very long time, and I guess we were all in love with the stock market for so long, and afraid to give away some of that upside in return for yield. But I think for, as you said, for the pre-retiree or retiree cohort, that's a really, really important and essential option that's available is the covered call, overlay strategies.
Yeah, and if you look at the kind of markets we're in right now, like if we're in a down market or if we're in a volatile sideways market, these types of strategies actually tend to perform very well in those markets.
Sure, I mean, because of the uncertainty, the height, the increase, heightened volatility or increase in overall volatility is definitely providing higher premium income.
Yeah. And also, one important thing that goes back to sort of portfolio construction, not all buy rate strategies are managed the same way. So when I'm talking to advisors and PMs, it's really important if you're going to be considering this type of strategy, you want to look at what's under the hood and how they're being managed. Right. So in terms of the way that we do it, we want to be really mindful of capping that potential upside. The goal really is we write on about half of the portfolio. We're not writing on the entire portfolio, and that's an important distinction to make. Because some of the strategies available, they might write on 100% of the portfolio, and you're giving away more upside. So what we try to do is we want to sort of hit that sweet spot between, we want to provide the additional yield, but we also want to capture the majority or as much upside as possible over time. So we're only writing on half the portfolio. Another really important point is that we're always writing above current market prices, and these things are being reassessed on a daily basis because we want to be able to provide a mixture of the income and the growth to clients. We don't just want to provide the income, but then not have any growth potential. So I think that's a really key point to make. I mean, sometimes if you're analyzing different options strategies and different ETFs available, some of them might have yields, upwards of 9 or 10% right now. So I would say for the advisor and PM, it's really important to look under the hood and to find out, is the management team writing on 100% of the portfolio? Right. Are they writing at the money options? Because these types of things can cap the return even more. So even though that yield might be really eye-popping, you're not going to get that upside capture that you want. So ideally, you would get a mix. You don't want to sacrifice all of the growth potential. So I would say that's a really important point to highlight when you're looking at these types of option strategies. So a couple tools that we have for advisors and PMs that are interested in this type of strategy. We publish our monthly derivatives and volatility report, which
Okay.
I haven't seen anything that shows this degree of transparency on options-based strategies. So the advisor, by looking at this one pager, you can see how these strategies are positioned, and you can also see, the mix of the yield coming from the percentage coming from the dividends versus the options. And you can see the consistency over time, but you can also see how nimble and how active they are in terms of, the strike prices and how far out of the money they are in response to market conditions. So when markets are very volatile, our PM team can actually write the options further out of the money because we're able to get fatter premiums, but then we're able to actually capture more of the upside when the markets turn around. So that tool is a fantastic tool for advisors and PMs looking to wrap their heads around that strategy. It's really transparent. It's easy to understand. We also published a 5/5 report that advisors can actually use with their clients, and it's our top 5 picks of ETFs yielding over 5%, and that's published also on a quarterly basis. So these are the types of tools that we can provide to help support advisors in those conversations.
Yeah.
So I think that's an important thing to highlight. I think we hit everything else. Really, we talked about the tools, the support, the trends that we're seeing, the tax loss selling. These are great things to keep in mind after a year like this year. But I think one of the key things that I would want to highlight is definitely that volatility center in those tools to help advisors have those challenging conversations, given how difficult markets have been this year, and to help their clients stay invested in the importance of that over time. If I could leave, one impression today, I think it would be that one, because I think that that's the biggest difference they could make for their clients.
Well, I agree with you. I think having the ability to put things into to be able to present things to your clients visually is very powerful. And Erika, I'm so impressed by what you and the team at BMO Global Asset Management ETFs are doing. I think the portal, the BMO ETFs.ca portal, is impressive and does offer advisors really valuable tools for especially navigating this market that we're in right now. And I guess one final point that I would add is that it's very important, I think, to remember also this is no time to abandon the 60/40 portfolio. If there was a time, it was probably the end of last year.
Hindsight, 2020, right?
Yeah, 100%, right? But I was particularly impressed by Steve Cohen's assertion, Steve Cohen from SAC. When he was asked what he thought of the 60/40 portfolio, his response was very surprising. It was that this is a great time to be a 60/40 investor, right? And I wasn't expecting it. I don't think the host was expecting the answer to that question to be that. But the point was very simple. Stocks are depressed. Bond prices are depressed. There's yields. Anybody coming into the market right now, 60/40 is a fairly attractive proposition. So what I get from that is, okay, if you're a well-heeled investor being invested, 10, 15, 20, 30 years, and you're worried about your current position in the market, this is definitely not the time to exit risk. And, despite the emotions that are running right now, and the feeling of doing, the feeling like that's what you need to do, given the regime change that we're sort of encountering right now. But that was my point. My point is, this is no time to exit risk. The time to have exited risk was the end of last year. And if you did it, wonderful.
And
but
if
you
didn't, you have to hold on and stick to your
Absolutely.
guns. It's not the time to reinvent the wheel. And, it really highlights the cyclical nature of markets. It's tempting always to say this time's different because this, but the reality is that markets are highly cyclical. And, just because bonds have been a tough place to be over the last year, I don't believe that's going to be the position that we're going to be in a year from now. So I think it's actually a really big opportunity for investors to start looking at over the next
use
next
the
year.
tools. Use the tools that are available. Educate yourself if you need to, and take advantage. By all means, take advantage of the tax loss selling opportunity that's available today, which is an opportunity to move your assets around from one risk budget to another, and also currency.
And also, potentially
Yeah.
make your portfolios more efficient and more scalable
Yeah.
over time. I think that's, key takeaway and an opportunity that tax loss selling in these bad markets are presenting us with right now. It's sort of that silver lining.
So many.
Yeah.
So many right now. Erika, it's been really a pleasure to talk to you. Thank
Thanks,
you so
Pierre.
much for your
Likewise.
thank you for your valuable time and your insight.
It's my pleasure. At the end of the day, we want to help our clients do the best that they can for their clients, and I think that we're very passionate about that. So, we put together these great tools, and we're happy to have that conversation anytime about how we can help you do that.
Wonderful. Thank you.
Thanks.